Thank you everyone for coming. My name is Anthony Morena from the Mortar Group. We are a New York-based real estate firm. So we're going to go through some of the work that we do. We're going to talk about where the market is in general on a national basis and recessions coming and projected, and how we adjust in those markets and just general thoughts on that. Before we start, we always have the disclaimer on risk that we're required to provide. And before we get started into discussion about the recession and potential items with that, just to give you some background about us, like I was saying, so we're New York-based. We're integrated firm, a vertically integrated firm, where we target small to mid-cap deals in New York City, specifically New York City. We work as the construction manager, the architect, the developer, and the investment manager. Over the years, this is a model that's we've assembled that we've found to be pretty efficient in targeting the types of deals that we do. We're focused strictly on New York City, prime neighborhoods. Manhattan, Brooklyn, and Queens, if you're familiar with New York, are our primary markets. Sub-institutional, mid-cap real estate. And we do a blend, and usually depending on where the market is, it's a 50-50, 60-40 split of ground-up construction and your more traditional value-add work. Typical assets that we do are 10 to 40 units, $10 to $50 million in traditional valuation for the deals. And we tend to work in neighborhoods that we know. Manhattan, Brooklyn, Queens. Like, I grew up in New York, went to school in New York, and as Mortar has been going on and growing, we looked at the idea of potentially expanding outwards into other parts of the country, especially during COVID. But I always felt that working in a city that I know like the back of my hand was a specialty that we wanted to stick to, especially in our small to mid-size range. We don't compete with a lot of the bigger institutional funds, private equity guys. We have a nice niche that we work with where we can be efficient and attack offerings pretty quickly. We work on a syndicated basis where we'll have presentations or different offerings that come up, and it's project by project, or it'll be an assembly of different projects that come together. And we, at this point, we have about 425, 26, I think, investment partners now that we work with across the different deals that we do. We have about, I would say, 4 to 6 active deals or active offerings that we do every year. And since I started in 2000 or 2001, we've done a little bit over 30 deals. We're probably around 33 or 34 right now. $306 million in gross sales. In general, sponsor equity that's invested right now is around, I would say, it says 9.1 here. We're probably around 9.3, 9.5. But basically, we co-invest in every project. We, meaning me, as the general sponsor. And we provide usually a 5 to 10% co-invest, personal guarantees on the debt. And then the rest is kind of put together through a syndicate of investors that we come to work with over the years. So just a little bit about myself. I started off as an architect, went to architecture school, graduated as a licensed architect, got licensed in New York City. And very quickly in my career, which was more kind of strictly service-based, I felt I didn't have much control over the situations that I was designing or that I was working on. So the idea was to create a firm where we could manage or design the products that we did, the deals that we did, but also control them at the end and had more control on the financial output. So that was kind of the precipice for Mortar and the evolution that kind of happened over the years. Early in my career, we started from a small 3-family in New Jersey, and then with some other developers, we did 500 units in 42nd Street on Manhattan's West Side. So I've kind of seen the lows and the highs as far as the construction metrics. And I've seen a fair amount of the good and the bad markets, starting in 2000, with New York. September 11th was 2001, which was kind of right at the beginning of my career. Then we moved right into Lehman, then to COVID, and, the market that we're in now. So I've seen the highs and the lows, which I think, every investor, every sponsor should be pretty familiar with because they change. They're all different and unique each time, but it's valuable information to have. So just briefly, as we start to get into talking about, recessions, recessions are one of those things that are forecasted all the time, depending on what media outlet or what you read or what you watch. And, ultimately, no one knows when they're coming. They usually kind of start with something that has nothing to do with the financial market in particular, and they kind of snowball. Credit markets freeze. You can't spend your way out of it, and you can't borrow your way out. The credit markets are frozen, so you're kind of stuck, and you manage through it. So in managing through it, the best thing you could do, or the way I look at it, is you prepare for it. In going through a couple of different cycles, you try to be conservative. That's a word that gets thrown around a lot, that sponsors and real estate and other stuff, they try to look at things conservatively, but it's something I think everyone needs to be really serious about. Just with the basics of a recession. Recession is when you have two quarters of negative growth in GDP. And usually what happens with that is actually it'll be on the next slide, is recessions will hit the stock market, real estate markets, credit markets, like I said, everything gets hit. There's no way to hide from it. It's just one of those things we have to deal with, attack proactively, and just work through them. Being prepared is ultimately the best way to manage it. Each recession has some event that causes the decline. The recession hits, unemployment shoots up, interest rates drop, and the path towards the cleanup of the recession then kind of takes place. The recessions themselves, they're pretty short periods. Even 2008, 2009, the recession was 6 to 12 months, but it took a couple years to really kind of come out of it, and I think it's pretty much the same with most others. COVID and the recession that was tied to that, I really kind of look at that as a bit of an anomaly, which will be double stacked by, I think, whatever financial crisis hits us in the next couple of years. But we'll have to see how that goes. In general, the first thing we always try to look at, both personally and as an investment company, is you want to be liquid. You want to have cash on hand, cash reserves for when things go bad, for any assets that we have going on, any offerings, any deals that we have in process. The bumps that you will realize during the recession are short term. If you can get past them and you plan for them, you can get through them, you get out to the other side, and deals still ultimately can do well. If you're not prepared, the deals go bust, they go into default, bankruptcy, and a lot of different things that you'll see and read online. The real estate market in general, while the stock market and the general market in the country has been pretty strong over the last, I would say, 12 to 24 months, the real estate market's been hammered across the country, where rates shot up, doubling and tripling from where they were, and a lot of deals and a lot of newer sponsors that were kind of doing projects and didn't have liquidity or enough contingency in place. Those deals went bust quickly when they were valued or modeled using a 4% interest rate, and then their interest rate when they had to go renew their debt was 9%. Just doesn't work, and they were underwater. So liquidity is kind of one of the first things we try to look at. And then in general, and this is something for us that we'll do usually every 6 months, is kind of look at the debt that we have, deal by deal. So for us, we have construction projects that we'll have ongoing, which are usually on a 3-year cycle. Your more traditional value-add deals that take about 3 to 4 years. And we have our existing portfolio of assets that we manage more on the long term, 5, 10, 15-year assets. And we'll look at the debt on all of those, and where is it? When is it coming due? What's our rate? What can we take advantage of in the market to make adjustments, whether refinancing or repositioning? Or, how do we plan for what we think is coming? So I think that's a big part of it, just being proactive and knowing, where you are. In general, a lot of these concepts and these tips are not so much groundbreaking concepts, they're just the basics. Know where you are and be realistic. A lot of times, people tend to get stuck in pro formas and metrics and the hope of something, how you hope something is going to go this way or that way. And a lot of times that is not a good recipe for success. So you try to be realistic, and whether the reality is good or bad, you just have to deal with it and you work your way through it. So in general, there's a lot of different markets you can go through. There's a lot of different ways you can look at things and what to avoid or what to jump into. But a lot of times it's sticking to the basics. Stick to the deals that make sense, the fundamentals. Your indexes, your consumer staples, healthcare, bonds, and real estate if it's purchased or it's put together properly. In general, recessions are the time, there's that short period of time from 6 to 12 months where everyone is in a full panic. And if you weren't on a panic on your own, everything you're reading and writing is forcing you into a panic that the sky is falling. And it is, but it is on a short base. The idea is just to be proactive and, look long term. You will get through this, the recession will recover, or the market will recover from that recession, and you want to understand where are you going to be at the end of that recession and moving forward. And with that, you try to look at what are the values, where's the benefits, what are the new things that are going to come, the deals, the offerings, the discounts essentially that you're going to see on assets or stocks or businesses where you could take advantage of by having the liquidity which was part of your preparation for a recession, and where can you try to take advantage so when the economy bounces back, you will be 3 times stronger than you were, in the middle of the recession. Typically, there are many items you should avoid, and hindsight is always 2020. Is always 2020. It might have looked clear at the end of the recession or when you're coming out of it that I should have done this or shouldn't have done that. But it's not always clear at that time. But in general, you want to stay away from the stuff that's super high yield, highly levered, discretionary stuff, discretionary stocks, and the penny stocks that are or stuff like crypto where you're kind of looking for that quick bounce around, that quick gain. The idea in a recession is to stick to the fundamentals, work your way through that period so that you end on a stronger basis. I think that's ultimately the goal. With us in real estate, you're working with your different groups of lenders and your investment partners, and the idea is that when any deal that we look at, the metrics start to present themselves, they start to be favorable. But real estate deals, but you always have to be cautious of your leverage. Your leverage, which in a great market might shoot up to 70, 75%. In these kind of markets, you drop it to 60, 55, it drops significantly. So in the event of a storm and you need to readjust your debt, that doesn't put you underwater. A lot of the guys or, a lot of the sponsors sometimes will get into trouble when it's too highly levered. I mean, we saw this a lot, in 2008. Back then, I was earlier in my career, but you had deals that were, back then there was more, at least in New York, there was more mezzanine debt. So you were getting traditional lenders that were giving a loan for value add or construction that was at 65, 70%. Then they were getting a 20% mezzanine loan on top of it. And then they were probably getting some other tranche a little bit above that. So there was maybe 5% of actual room in that project. So if anything moved in the slightest way in the negative direction, those deals were toast. That's the short way of just kind of describing a lot of the things that happened through 2008. And with that, for myself, I tried to learn from it. We had projects that went to market in 2008. I remember specifically we had one that hit the market. I think Citibank stock had gone all the way down to $1, and people weren't sure if Citibank was going to go under the next day, and no one knew what was going on. So the idea was just be preventive, and shore up your resources. For us on the deals that we had there, we tried to, lower our debt, lower our costs, value engineer the deals, get out of them as best we can, with the ultimate goal there being protecting investor equity. That's, when the market goes sideways like that, you fall into not trying to hit your ultimate IRR initial objectives. The objective is try to give a return, protect capital at all costs, because like I was saying, the recession is short term, and when you come on the outside, you want to be one of the sponsors or investors that did marginally well, and you don't want to be one of the guys that's down 30% on your stock portfolio, real estate portfolio during that recession. So you have to go through it. It's one of those things that we never know when it's coming. There's all sorts of different charts. real estate has its notorious 18-year cycle that it goes through, and you never really know where you are in it until you hit it. But there are opportunities, so that's what we try to keep in the back of our head, where as we're navigating these deals, where can we benefit? A lot of times, like even now with some of the markets in real estate where people have been hit with high interest rates over the last 12 to 18 months, there's value that's starting to be presented for us. Because we've been doing it for a while. There's a lot of companies that we work with where they'll start to offer us distressed deals, where a deal that went bust at X dollars, it's offered at Y, so there's a discount there, and we try to take advantage of that because we can be positioned for it. So that's kind of part of the goal that we do. But in general, in recession, it's regardless of what you see and read and all those things, just don't panic. Be conservative, stick to the fundamentals. Don't get cute is one thing I've learned just over the years. And it always comes to an end. The recession is going to be is chaos, but it comes to an end, and the markets stabilize, and then they start this slow progression to normalcy, and then there's usually that spike in the positive direction. And if you can catch that wave on the positive direction, you really put yourself at a great advantage. Even with a lot of deals like in New York after September 11th, after Lehman in 2008, even after COVID, there were a lot of deals that we were able to acquire during those times that it might have taken a few years for those to see the positive end, but when the positive end came, it was substantial. You were 2Xing, you were 3Xing deals. And those are the deals that really kind of can set you apart. And with us and with the investors that we work with, you make more friends on the investor side and the investor relationships during a recession. When investors see how you manage a recession, how you work through it, how you communicate with them, how realistic you are, those are the times where I think you make the best relationships. Even with the contractors we hire, brokers we hire, my question to them is, how did you do during a down market? If you weren't doing well, you're not the person I want to work with. Because when the market's great, everyone looks like a genius. Everyone looks like they're the best thing in their market. But it's really how you do in those bad times that's really kind of the thing that I look at. So just to kind of give you a little bit about us and some of the work that we do and kind of some recent stuff that we've been doing. Like I was saying, so we're New York based. We focus on a mix of ground up development and value add. A lot of the work we do on the ground up side is condo for sale developments, if we can find a market that it fits well. And the other is the more traditional value add. We'll take smaller buildings in the outer boroughs, Brooklyn or Queens, and reposition them or put them together. We'll buy, I would say, 3 to 5 buildings, put them into a portfolio, and offer them to syndicated investors where they get a chance to take part in a bunch of different buildings, spread risk around, and it gives an opportunity to invest and take part in a different part of the market that they wouldn't normally see. Like I was saying, because we're on the smaller to mid-size, we get the deals that we kind of take advantage of are the deals that are kind of not looked at by the private equity guys or institutional because they're just too big. They need to look at a deal where they can write a $25 million check, $50 million check. We're writing $5 to $10 million checks. So in that, we're above the mom and pop, below sub-institutional, and that's kind of been our niche. And I think because we focus strictly on New York, that's become our expertise. So when a deal comes up, we can know, where it is, the price points, and how quickly we can turn it around. One of the big things that we've been doing, especially I think since COVID and the markets changing over the last few years is, our original offerings used to be longer. I would say 3 to 5 years would be the traditional offering. Now we've kind of shortened it down. It seems like a lot of the investor sentiment has been towards, deals where they're 30 to 36 months, project-specific offerings where we'll come in, we'll put a deal together, we close on the asset, and usually, on average, it's usually 30 months. Sometimes it's a few months sooner, a few months later, but overall, that's kind of the timing. This is a project in Williamsburg, was a really nice project that we started during COVID. It caught the wave on the rental increases in 22. Market did really well. It was repositioned, and from a purchase price of $2 million, plus construction costs, and we had an exit of 6.8. Great deal that worked well for us. But again, we bought it in from a distressed situation where it was coming out of COVID. 95 Diamond was another one similar to this. And again, some of these offerings are are put together with other investments that we do together in portfolios, but just to kind of break out some of them individually to kind of see how we do. And again, another one, which was a small renovation, taking existing assets, repositioning them, adding onto the buildings, gut rehabs, which usually take about 18 months. So between 6 months of prep, 18 months of construction, 6 months of leasing, and then sales and financing, all that kind of stuff. So it usually ends up around that 30-month area. We've done pretty well with these over the years. The other thing that I kind of like about the market that we work in is when you start to buy bigger assets in New York, the prices go up and the value does not go up comparably. If you try to buy an asset that is $10 million in Manhattan versus outside the outer boroughs, the value is not the same. You can get more bang for your buck on an investor return side for working outside in the outer boroughs. So that's kind of where we focus. I'm not focused much on the ego and of ideal locations where I think people might like to invest. It's more kind of what's efficient, what is an area that's gentrifying that can, where we can do well and be consistent. That's for us is really the key as a small company, is being consistent, doing one project at a time and kind of building this base. For me, starting in 2001, my first project was my 3-family with my dad. We partnered together for one deal, and we had enough of each other at that point, but it was a chance for us to kind of cut your teeth and do well. And then from there, people start to see what you did, and they start to go from 1 person to 10 to 20. And now, for us having to 400, I think it's a nice, it makes me feel good about what we're doing, and it's kind of this slow build up. Not trying to hit home runs, we're just trying to be efficient and knock it out every time and build from there. And then just kind of giving up an offering update, because I know, like I was saying, the market's been turbulent, depending on what you read in the last couple of years. But for us, I think we've been doing pretty well. We doing a mix of ground up and value add. We do different offerings with investors. We have some where preferred equity that are kind of more just set interest rates that are higher rate, a second in line to debt for senior debt. And that project is finishing up. Vision is finishing up this year. Hopefully by this summer, that's wrapping up. District Lofts is an offering that we launched in 22, which was 3 buildings that we finished everything up as far as the renovations that we initially planned for. So usually what we'll do is when we start a project, the first year is mostly construction. It's getting the low-hanging fruit, renovating as many of those units, increasing revenue, and then just kind of building it out from there, stabilizing an asset after that, lowering your operating cost in years 2 and 3 as you prepare for an exit and a sale. So with District Lofts, it's the same kind of thing. The debt we secured there was at 3 3/4, which this was at the end of 22, and we were not happy about that interest rate at that time because we thought we can get lower, and everyone was kind of bent out of shape. But looking back at it, 18 months later, it just seems like the most. It seems crazy at that time. But the first year returns were issued, objectives were met there. We renovated most of the apartments, met our goals on the renting end. So it was just kind of we can continue, and then this deal will close up probably in the next couple of years. And it will exit where then you'll have sale of the asset where the debt is paid off, investors are paid their initial equity return, and then it's just a return of the distributions and gains to the investors. So we'll have more updates hopefully in the next couple of years as these kind of start to wrap up. We try to keep everyone in the loop just as on our projects and how we do them. This is another project that we launched last year in Newtown Flats, the same kind of setup. Again, smaller deals that I couldn't put together in a portfolio where, and I don't know, it's hard to read this, but this graphic was more meant to be of where we'll look at every single unit in a portfolio, whether it's, in this case, it's 18 units, whether it's 18, 30, or 50 units, it's unit by unit, where the original rents are, where we think we can get them in the next 2 years. and how we can increase them, which ultimately can increase the value of the asset, which makes, for the preparation of the exit. So overall, I think our increases, have been pretty good. We've been pretty efficient on that. In New York, like every other, state, you have to deal with your rent code, rent control laws, your habitability laws. So those are the different things you have to analyze. But for us, I think we have a nice niche that we work in, and we try to be efficient in it. And like I was saying, like being in the market for a while and doing this for a while, it comes second nature to build in the margins and the protections, like going through '08, going through COVID, and all that kind of stuff. Well, COVID is a bit of an anomaly all in itself, that underwriting has changed as a result of that. But you just try to build in margins. You try to have enough liquidity. Going back to the original slides, liquidity, being prepared and knowing where your debt is, where it's going to expire, and what are your exposure points, what's your weakness, and then prepare for the worst case scenario, and you shoot for the upside. And usually you end up someplace in between, and then everyone is happy. Your investors are happy. They get their money back on time, no surprises. The sponsor gets to exit a project and look to doing more deals and just building a business. So that for me is what we do, and our goal that we target on every deal. And that is it. Thank you, everyone, for taking a few to listen. Any particular questions or?
I got a question.
Sure.
Thank you for the presentation. I think I've had a lot of discussion about real estate at this event. I think a lot of people are interested in funds.
Mm-hmm.
At this particular event, there's some good things with that. How would you compare and contrast? What would be a benefit to do it this route? What kind of investor might benefit from this route versus an investor that would be better off?
Sure. No, it's a good question. It's something we deal with a lot because we're a smaller shop, we don't compete necessarily with a lot of the bigger guys, the bigger funds. Seem like a lot of the guys that are here today. For us, we found that in the niche that we work in, investors always wanted to know, where's the deal? What's the project that you guys are working on? And for whatever reason, my background is architectural. So it's not finance, so I have a kind of maybe a different perspective on how things are and how you should present. So I always found it being more comfortable for me to kind of find the deals, put together a package based on, and then try to see who was interested. And as our investor base grew, it was just like, okay, hey, we found this asset. We think we can make this work. And we send it out to everyone and kind of see what their thoughts were. And the pricing structure was also different, where we can move quicker on some of these smaller assets. And one thing I found over the last few years, especially going through COVID was that a lot of the funds have longer terms. 5 years, 10 years. You have some that are evergreen that there's at no point that they're going to end, which is fine. But for us and for what we're trying to do, the market has so many ups and downs, and especially in the last 5 years, it's like I want to be able, if I start something today, I can't predict what's going to happen in 3 years, but I have a better idea of what's going to happen in 3 years rather than 10. You know what I mean? And then also the other thing was with a fund, the funds will charge usually an annual management fee on the equity. So in doing it this way, we charge a management fee to the asset. It's not, so if an investor invests $10, we're not taking 1% of that a year. We're not charging the investor anything. We're being paid in a different way just through the asset itself. So it's a little bit different. They all run, we run through the same kind of setups, but it's a little bit different. Yep. Yep.
In each one of your deals, you have different class of investor, like private equity would get say a 10% no share on the upside versus another class of investor that takes a little bit less of a crack but shares on the upside. You have different classes.
It's all pretty much the same. We keep, we try to be fair about it, and we have, there's a Class A and a Class B traditionally. The Class A is the equity investors. Class B is the management entity, which is us. What we do offer sometimes, because we've had some investors ask for it, is not so much to be an investor in the more traditional way. We've had some investors that want to do debt, where they'll say, hey, we'd like to provide a portion of your debt at a set interest rate and take part in the deal that way. They don't have any ownership in the entity. It's not a guaranteed investment in that way. It's a non-secured debt. But it's another option that we've given people just because we've had more and more people ask for it. Like especially in this market where rates have shot up, and this is usually more for the construction deals where we have the ability to do it. On the value add stuff, it's really hard to put a pref piece in. But on construction, we've had that. And we've had some success for it where investors have been happy with it. Yep.
Do you have any deals in qualified opportunity zones?
Not right now. We've had some that we've looked at, but we've never been able to get the numbers to work. New York, the way they broke up the opportunity zone map, it makes it really hard to find a deal that will pencil well, because it's usually in an area that really hasn't grown yet. So we don't have that much confidence in those markets. So we try not to do it just from a risk analysis perspective. There are some that we bid on where they bid on the borders, but we've never been able to put one together. Yep. Yep.
Talk about liquidity a few times.
Mm-hmm.
Talk about origin liquidity.
Mm-hmm. So how do we prepare for it? So a couple of different ways. One is, as the sponsor, we have equity invested in the deal. I have a personal guarantee in the deal. So as the sponsor, I have to have liquidity reserves to handle that. So in the event that the lender comes calling and I have the personal guarantee, all of our investors are passive, but the bank will come to me and it's like, hey, you need to show liquidity that you can handle that storm, Mortar as a company. So that's the first part. And then the other part is we'll build in contingency reserves in the project that are usually a minimum of 10%, that they'll be stashed on the side. And at the end of the project, if they're not tapped and we're not used, that goes back to the investors as part of, it's not a bonus, but it's just an extra gain that wasn't really accounted for. So it's a combination of those two that you protect yourself. You try to give yourself enough margin. The margins where you can get hurt. So it's like if you can protect yourself that way, I think you usually withstand most storms. Cool. Yeah. All right.
Questions in the back?
Yeah.